Welcome to This Explainer. Today, we're going to unpack a totally fascinating story about the hidden power dynamics driving this massive artificial intelligence boom. When everyone else is mesmerized by the shiny new computing chips, the smart money is usually looking at the infrastructure that actually makes those chips work. So, we're going to dig into Infineon Technologies using their latest August 2026 financials to see exactly how they're positioning themselves as the silent engine behind both the AI and electric vehicle revolutions. Here's our roadmap for today. We'll kick things off with AI's hidden power problem. Move beyond the GPU, dissect the earnings turnaround, solve the valuation mystery, look closely at the high-voltage risks, and wrap it all up with the final verdict. All right, let's jump right into Section 1, AI's hidden power problem. I want you to think for a second about those massive data centers being built all over the world right now. We hear endless talk about the computing brains, right? Companies like NVIDIA designing the GPUs that train these giant language models. But I want to ask you a really fundamental question. What is the one thing AI absolutely cannot live without? Because if you remove this one single element, the most advanced GPU on the planet is literally just a very expensive paperweight.
The answer is power, electricity. AI servers are consuming absolutely enormous, totally unprecedented amounts of electricity. But hey, it's not just AI. Electric vehicles need highly sophisticated power routing. Automated factories require hyper-precise motor control chips. Renewable energy systems desperately need intelligent power management devices. Electricity is the absolute fundamental constraint of our technological future. And positioning yourself right at the center of how that electricity is converted and managed, well, that is the ultimate Trojan horse investment strategy.
So, let's move on to Section 2, Beyond the GPU. Look, Infineon is not a GPU maker. They are a specialized power and control semiconductor company, and they are deeply embedded across multiple critical industries. We're talking automobiles, industrial equipment, renewable energy, and of course, massive data centers and EV charging. You see, electricity doesn't just magically flow directly from the grid straight into a super-sensitive AI processor. It requires incredibly sophisticated power management systems to step down the voltage, convert the current, and manage the insane heat. So while the GPU might be the brain, think of Infineon as the cardiovascular system, pumping energy precisely where it needs to go. And a huge part of what makes this possible is a specific technology called silicon carbide, or SiC. Think of your standard silicon as a regular old garden hose, okay? Well, silicon carbide is like a high-pressure fire hose. It handles much higher voltages and extreme temperatures with significantly less energy loss. If global electrification is actually going to accelerate, whether we're talking about fast-charging EVs, massive solar arrays, or next-gen data centers, silicon carbide demand has to accelerate right alongside it. It's absolutely vital for managing the massive power loads we're expecting in the future. Which brings us to Section 3, the earnings turnaround. Just take a look at these figures from August 2026, because this is where the story gets incredibly compelling. Trailing 12-month revenue sits at $17.81 billion. Now, that's a solid but, modest increase of 6.5%. But look beneath the top line. Net income exploded by 73.1%, and earnings per share literally skyrocketed by 75.1% to $1.05. I mean, you rarely ever see a 6.5% revenue bump trigger a 75% explosion in EPS. This massive gap tells us that their profit margins are expanding incredibly fast. And this brilliantly illustrates the chain reaction of their cyclical recovery. Remember back in fiscal year 2025? Infineon's numbers were notably weak, with earnings actually down over 21%. So what we're witnessing right now isn't just a straight line up. It's a textbook cyclical turnaround. The semiconductor cycle bottomed out, AI and auto power demand finally stabilized, and that allowed gross margins to rapidly recover. And that directly caused the massive acceleration in EPS we just looked at. All right, let's unpack Section 4, the valuation mystery. As an investor, if you're looking at Infineon right now, you are faced with a pretty glaring contradiction. The trailing price-to-earnings ratio, which, remember, looks in the rearview mirror at the past year, is sitting at a sky-high 60.9. But the forward PE, which is looking ahead to next year's estimates, is just 21.4. That is an enormous gap. It's an astronomical trailing valuation juxtaposed against a surprisingly reasonable forward valuation. So how do we resolve this mystery? Well, it's actually simple. The market is pricing in near perfection. A forward PA of 21.4 relies entirely on future earnings actually meeting those highly optimistic expectations. The market expects earnings to rise sharply, and that right there introduces significant risk. If they execute flawlessly and hit those targets, that high valuation normalizes really quickly. But if earnings disappoint even a little, that trailing 60.9 PE is going to feel like a massive anvil pulling the stock price straight down.
That segues perfectly into Section 5, high voltage risks.
Look, we have to look objectively at the macroeconomic landscape here. Infineon is a massive global company with heavy exposure to Asian markets, specifically China. And this means geopolitical realities must be weighed as neutral facts in your investment thesis. US-China trade tensions, shifting export restrictions, incredibly fierce local Chinese semiconductor competition, and any fluctuations in Chinese industrial demand, these are all major variables that can heavily impact Infineon's bottom line. And beyond geopolitics, we have to talk about the automotive cycle. While the long-term trend absolutely points to more semiconductors per vehicle, thanks to EVs and driver assistance tech, car manufacturing itself is notoriously cyclical. If global car production falls, or if automakers simply decide to slash their inventory levels to save some cash, semiconductor orders are going to plummet. Long-term structural growth just does not protect a stock from falling significantly during a short-term automotive down cycle. And that cyclicality, it's perfectly captured by this one number, 1.95. That is Infineon's beta. For conservative investors, this should be a blaring siren. A beta near 2 means this stock is nearly twice as volatile as the broader market. I mean, the 52-week trading range is a staggering $35 to over $103. If you're looking for a stable, sleepy dividend stock, especially since this pays a negligible 0.42% yield, this is definitely not it. This is a high-voltage, highly volatile asset. Do not chase parabolic moves here.
Okay, time for Section 6, the final verdict. Looking at the overall risk profile, I'd grade Infineon as a medium high-risk investment. Yes, the massive, undeniable tailwinds of long-term electrification are fantastic, but we have to recognize they're currently offset by the high risks of the semiconductor cycle. Also, for my US viewers tuning in, keep in mind that the ticker IFNNY trades over the counter. That means OTC liquidity is an additional high-risk factor you absolutely must carefully manage compared to their primary German listing. So let's break down the actionable parameters. The verdict here is a buy on pullback. Your ideal setup is watching the price drop while fundamentals, like that silicon carbide demand and gross margins, actually rise. It's a solid hold if EPS continues its steady recovery and management maintains their financial discipline. You definitely need to keep a close watch on China's industrial demand and global auto inventory. And finally, it becomes a definitive sell if those sky-high EPS expectations suddenly collapse while the valuation remains elevated. To wrap this all up, I want to leave you with the core thesis that really anchors this entire explainer. NVIDIA and others might be building the computing brains of AI, capturing all the mainstream glory and headlines. But AI still needs electricity, and modern electricity desperately needs advanced semiconductors. Infineon is positioned right at the heart of that hidden critical infrastructure. The data shows us an incredible earnings recovery, but as we saw, the market is demanding absolute perfection to justify the price. So I'll leave you with this to chew on. Does your portfolio actually have the risk tolerance for a high-voltage, highly cyclical turnaround play in the AI-powered sector? Really think carefully about that beta of 1.95, weigh all the data we've covered today, and structure your strategy accordingly. Thanks so much for joining me for this explainer, and keep learning.